This episode of the Altco's Mainstream podcast is brought to you by Ultimus, a leading full-service fund administrator for asset managers in private and public markets. As private markets continue to move into the mainstream, the industry requires infrastructure solutions that help funds and investors keep pace. Ultimus is a leading full-service fund administrator for asset managers in both private and public markets, offering a wide range of capabilities across registered funds, private funds, and public plans, as well as outsourced middle office services. Delivering operational excellence, Ultimus helps firms manage the ever-changing regulatory environment while meeting the needs of their institutional and retail investors. Ultimus provides comprehensive operational support and fund governance services to help managers successfully launch retail alternative products. Trusted by institutions, investment consultants, registered investment advisors, state governments, and fund managers, Ultimus provides solutions for nearly every investment structure in the marketplace. Visit www.ultimusfundsolutions.com to learn more about Ultimus's technology-enhanced services and solutions, or contact Ultimus Executive Vice President of Business Development, Gary Harris, on email at gharris@ultimusfundsolutions.com. We thank Ultimus for their support of alts going mainstream.
Everybody gets a piece, we're going mainstream. Everybody's gonna eat, we're going mainstream. All my family sing. See you on Main Street, we're going mainstream.
From Wall Street to Melrose Avenue,
We're going mainstream.
venture capitalists to athletes to
We're going
creators
mainstream.
to the person who's collected trading cards
We're going mainstream.
in a collision of culture and finance.
We're going mainstream.
Welcome back to the Altco's Mainstream podcast. Today's episode dives into the details of distribution and how to build a high-performing global business to serve the wealth channel across brands and strategies. John Sweeney is the Chief Executive Officer of Brookfield Oaktree Wealth Solutions, a business unit that was created to harmonize the distribution efforts across the Brookfield and Oaktree brands. He previously served as head of U.S. business development and sales for Brookfield Oaktree Wealth Solutions and was a managing director and head of the America's intermediary business at Oaktree Capital. He also served as president of Oaktree Funds from 2014 to 2018. Before joining the alternative asset manager side of the business, John had extensive experience working in alternative investments roles at private banks. Before joining Oaktree in 2013, he was a managing director and head of product management and development for the alternative investments business at Morgan Stanley. Prior to that, he was head of product management in the U.S. for the alternative investments business at Citi Private Bank. John and I had a fascinating and informative discussion covering how he's building Brookfield Oaktree's wealth business, the benefits of scale, wisdom from John's Oaktree colleague Howard Marks, and how critical advisor education is to the adoption of private markets. Thanks, John, for coming on the show to share your wisdom and views on private markets and working with the Wealth Channel.
In a collision of culture and finance.
We're going mainstream.
John, welcome to the Altco's
Michael.
Mainstream podcast.
It's great to be here. Thanks so much for having me.
Pleasure to have you on. You yourself have such a fascinating career in private markets, working with the Wealth Channel. You've seen it from so many different vantage points. And then obviously all the work you're doing at now Brookfield Oaktree Wealth Solutions. There's so much to unpack. So we'd love to start with your background and how you got to where you are today.
Sure. Happy to do it. And again, thanks for having me here. Big fan of you and big fan of the show. So it's great to be able to expose you to what I'm doing and what we're doing with our brand. But let me take you back. And sometimes people think I had a vision that alternatives were going to grow and become what they are today, because I really started in the late 90s, early 2000s at Morgan Stanley. Before alternatives were an alternative investments group, it was really at that time a collection of strategies, primarily private equity and real estate. And we were offering them out to ultra high net worth investors. And that ultimately morphed into the alternative investments business that Morgan Stanley ran. But I've been very fortunate and or lucky to have spent the majority of my career in alternatives, primarily at two great firms, Morgan and a brief stint at Citigroup, but alternative investments and high net worth investors. So as I look back over the past 25 years, and I've seen the evolution from a single private equity fund to managed futures to fund of funds to registered funds to hedge fund platforms to where we are today, it's been amazing, even just as a passenger or as a participant in that journey. And so excited where we are today. And honestly, to use a baseball analogy, I still think we're in early innings. There's so much room to grow. technology, new people, new GPs, new sponsors coming in have really made this accessible to so many more investors globally. And I think this is alternatives, broadly speaking, are really going to take off.
Why did it take so long over the past 25 years to get to where we are today?
I think technology has been a big part of it. I think back to those early days when you talked to an advisor, spoke to the client, then filled out a FedEx or a UPS slip, shipped it to them, tracked the books, had to write the number down if it were a private placement. And then I convinced you that this was a good strategy. I sent you a 100-page subscription document. It was very cumbersome. And then, hey, guess what? It was never on your statement, right? So I convinced you need to be in these asset classes. And then when it came time to your portfolio statement, it wasn't even included. So that was a big part of it. I think ease of execution that we're seeing today has really been a big driver of the growth. Quality GPs coming in and offering their strategies in a variety of different containers, whether that's REIT, BDCs, interval fund, tender funds, made them much more, I guess, widely accessible to a whole swath of advisors. So an advisor now can credibly allocate across his or her book of business, much more so than you could back in those early days when it was really sold to 10, 20, $50 million investors.
Working at Morgan Stanley, what were some of the biggest learnings that you've taken from that experience, albeit obviously a different time in private markets and its interaction with the wealth channel? But what did you take from that that you now are seeing as some of the big learnings from that or you're implementing today?
I would say probably the biggest would be more on the service side. I would say I had the benefit or the good fortune of having a lot of GPs come in and want to get on the Morgan Stanley platform. And you would sit there and credible investment strategies, credible people. At some point, you're at the whims of what the market offers you. I used to talk to people a lot about how are you investing what you can control, your distribution team, your distribution strategy, how you report, how you service, really the softer things, but I think that have become just as important. So when I left Morgan Stanley and joined Oaktree end of 2012 into 2013, I wanted to bring that mindset to it. Investment excellence, it's a given. You have to have great investment solutions, but can we marry that with a distribution strategy, a service and support strategy that ultra high net worth clients, that clients are accustomed to and deserve? So that was the mindset. And it started off, operate slowly. Do a few things, but do them well. Volume wasn't what we were going for when I first got to Oaktree. Establish some partnerships and execute on your promise. And that's both investment and service.
I want to touch on the service piece because I think that is so important. There's some level of the inability to actually control some parts of that service delivery to the end client. I want to touch on that because I think it's so important. At the end of the day, we've talked about this before too, that so much of this is about trust and building a relationship where you know you're going to deliver and the client knows you're going to deliver for them. But in the wealth channel, the end client, if they don't have a good experience, they're probably not going to come back. How do you think about that? And how do you make sure that both with the end client and the advisor, you're providing not just great investment experience, but also a high quality service experience?
I think this will, over time, favor some of the larger GPs with larger organizations that can invest in their own organization, whether it's your operations team or your platform ops or broadly what I would call investor relations. Because even though there are good service providers out there, you're exactly right. If a client has a bad experience with you, they're not coming back. There's plenty of choice out there. You really have to be on top of your service providers. You can't say that was them, not us. You own it through the entire chain. So it's a lot of shadowing. It's a lot of in the background, making sure your service providers are doing what you hired them to do. We work with a lot of different partners, a lot of great partners out there, but the business is evolving really rapidly from private funds to these evergreen funds. And that is, I don't say the thing, we're spending a lot of time, attention, headcount, resources on to make sure our back end is as good as our front end, because I know our front end is good.
As a large platform, and then we'll get more into this in terms of the partnership between Brookfield and Oaktree, the integration of the wealth team across both platforms, while still the firms maintaining their brands. How much emphasis do you put on and how do you think about staffing the wealth solutions organization to handle the service requirements that you just talked about?
Let me go back in history a little bit. So the business I'm running at Oaktree, we call the intermediary distribution business, successful in terms of assets and revenue. We had 8 people. Then I looked at Brookfield. They had both a private securities business in wealth and a public. When we came together in April of 21, that was about 30 people. That is what I call enough people to sell into the wealth channel. You can't build a business. If you look in just 3.5, 4 short years where we are today, we have 150 people dedicated to the wealth business and are primarily here in the Americas, US, Latin America, Canada, Europe, Middle East, and Asia Pacific. Probably 65% are front-end sales. The rest are what I would call our functional partners. Could be legal, compliance, service, marketing, business development, that entire ecosystem that's required to run a wealth business. It takes a lot of people.
Yeah.
It takes a lot of support from your parent organizations.
So I want to get to what it took to build the blueprint for a wealth business. First, I want to ask, though, talk to me about Brookfield and Oaktree, those two businesses, and how they intersect when it comes to the wealth solutions business.
So Brookfield closed on the acquisition of Oaktree, and I believe it was September of 2019. To your point earlier, still essentially 2 separate companies, but we knew in wealth, for everything that we're talking about, support, servicing, scale, it didn't make sense to have 3 different business units calling into a global bank. So we took that decision intentionally. Let's spend time, let's draw out which regions, the product containers that we want to build, the people we want to bring on, how we're going to structure our support network. So we spent from 19 to April of 21 really laying out how we want to attack the business. It was myself and my current boss, David Levi, spent a lot of time. What did you learn at Morgan Stanley, Citi, Oaktree? What did he learn in jobs and leadership positions that he had? And we were able to step back and think, okay, here's what we need to do to deliver on our vision or goal, which was pretty simple at the time. We want to provide the highest quality alternatives, solutions, insights, partnerships. Build everything around something as simple as that. You could fill in your people, your structure, your training, your education, just by stepping back and say, okay, in 3, 5, 10 years, what do we want to look like? We want to look like the highest quality alternative, solution, insight, partnerships.
Solutions, insights, partnerships.
I can drive a lot through those.
Let's break each of those down.
Solutions rather than just say funds. Really, we want to work with advisors, clients, and bring them investment solutions that they need in their portfolio. So that I'm talking strategies, funds, investments when I say solutions.
I want to touch on that point. Not to stop you, but I think it's an important distinction, because I think in private markets, particularly working with the wealth channel, words matter, definitions matter. Why is just the very act of saying the word solutions, why does that matter? And when you think about that, what does that mean? And how does that cascade throughout the entire wealth organization from distribution to service?
Here's how I view it. And I come from the wealth side of it. I liked when GPs came to me and understood what are my goals and objectives as a platform. I'm overseeing a big platform at a Morgan Stanley or a firm. What are my goals and objectives? Don't just come with your fund 5, 6, 7 and say, here it is. If you want it, here's the closing schedule. When I say solutions, I'm truly working with folks, creating a business focused on wealth. And I want to know what resonates with your investor base, what resonates with your goals, your objectives. And I think solutions is the right term for that. But you really have to step back. It's less about you and your goals and make sure you understand your partners and what they want.
How does solutions manifest itself in the context of the wealth channel? What I mean by that is the wealth channel is so broad in terms of the types of clients. You have ultra high net worths, who you mentioned, you worked with obviously at Morgan Stanley, and then Oaktree in the prior world of the private wealth channel was really working with ultra high net worth individuals who looked more like institutional investors. But then you have private banks, wirehouses, broker dealers, you have RIAs, you have platforms, exactly, you have regional differences. How do you think about the wealth channel and where you create solutions? Because it's hard to be everything to everyone.
You can't, it's hard. So first I would say, stick to your asset classes where you have expertise. And so if you look at Brookfield, real assets focus, think renewables, think infrastructure, think private equity, think real estate. And then when they really wanted to build out the credit vertical, that was the Oaktree acquisition. And there have been some other acquisitions, smaller but still important acquisitions. So start with that's the palette, or that's your jumping off spot. Then you have to pick which markets first. It's hard to do everything at once. Our biggest business today is in the US. So the decision we made was, let's move away from just private funds, Delaware, Cayman LPs. Let's think about, what are our partners trying to do? Increase advisor and client adoption of alternatives. You can't just sell qualified purchaser funds. So for us, it was, let's look at our business lines. Let's look at things like non-traded REITs, interval funds, BDCs, tender offer funds, see which match up, like the way I want to deliver to you and to our investors. Same target markets, same investment process, same team, same investment strategy. So let's marry those two. What's the right container that we can provide a solution to these wealth investors, starting with US wires, independents, RIAs. So a lot of those containers are broadly distributable in the US marketplace. And then it's, as you start building globally, you really need, okay, what markets do I want to be? We're going to be in Europe. Are we going to build the UCI Part 2 platform? We're building an Australian business. Are you committed to doing an Australian unit trust? So as you go around the world, if you want to be serious about these businesses, I think my view is you have to meet investors on their terms. Provide the great investment solution, but make sure the container matches the content that you're trying to offer out there.
On that point, are there only firms of certain size and scale that will be able to meet investors on their terms?
I think so. You could always partner with service providers. I think the enormous sourcing that's required to do this and do it in scale globally, one, it's going to favor certain larger GPs with big investment teams. But then to everything we've discussed about support, service, containers, oversight, I think talking my own book here as part of a very large alternative asset manager. But I think looking forward, yeah, I think that those are going to be the winners that dominate the wealth landscape globally. Those that can operate across multiple asset classes, that have credibility, that have history, that have experience, and can deliver in the container that's appropriate for the wealth client, I think that's going to win. It's not just us. There are plenty of credible GPs out there, but I think that's who wins. Right? If we view this with a 3, 5, 7, 10-year lens, there'll always be a strategy or a sector or something that raises money. Try not to confuse like luck with skill. You follow Howard, you've heard that. But I think those that can build a business, by developing a business, it's going to gravitate towards the larger GPs.
How do you then differentiate between the larger GPs when it comes to either the types of investments you have, the investment DNA, or the product structuring and containerization of how you deliver those products?
The container's hard to differentiate just on the container. You have to spend a lot of time on your brand. And I would say, I think about brand in two ways. I think your brand recognition. A lot of people know Brookfield, a lot of people know Oaktree, but do they know what our brand represents? Do you know Brookfield, 100+ year owning and operating assets? Do you know Brookfield in real estate, private equity, infrastructure, really owning and running those assets for themselves for most of their career, and then only becoming an asset manager in the last 25 years or so? Oaktree as a deep value credit investor, getting the brand value proposition across, I think is the more important maybe, but it's also harder. So that is print, that is media, that's education, that's training events, that's getting out there and having a team that can articulate what we represent. If you invest with Brookfield or Oaktree, this is what you should expect. If you're in our BDC or private credit strategy, we want you to understand, here's how we operate. Here's how we're different.
What do you find to be the most effective ways to get that brand essence across?
We've actually had a lot of success partnering, back to the partnership, in training education events with our global banking, wirehouse partners, even RIAs, doing joint events with them. We'll come in, bring in speakers, articulate what we're doing, maybe bring in an investment professional, teaching, talking about markets. I think those are very effective. We've also started to publish a lot. Like we've created the Alts Institute. We have a website that's more digital now. We will ultimately do our own events where we bring people in and maybe do a half day or full day across Brookfield and Oaktree. But most effective for us to date has been partnering with our partner firms that we distribute through and really doing joint events with them.
So that's why insights in the middle kind of ties the two pieces
Correct.
together.
It's like that glue that holds them together.
Speaking of insights, when talking to the wealth channel, I think the way in which you talk about both your firm as well as investment strategies and value proposition, does it require a different way of talking? Where, I mean, you've worked with institutional investors for quite some time as your two respective firms. How do you think about delivering insights and working with the wealth channel in the context of helping them understand private markets and the Brookfield Oaktree value proposition?
As we approach wealth, or as we share our insights into wealth, we'll write everything from 101 asset class introduction, 201 to 301. That's the interesting part of a lot of these wealth platforms. Their client base, their advisor base, super sophisticated, some newer just coming into the business. But actually, the way I look at it is they're all equally important. Like, we want to convert new advisors. We want to convert new clients. So we're happy to do the asset class, which we wouldn't be doing for an institution that has an allocation need in XYZ asset class. We're doing a lot of that in the wealth space, more the building blocks of alternatives and what makes these funds tick. But then we're getting very specific and very detailed, very institutional quality for other advisors in the book of business. But as I said earlier, both equally as important.
Do you think advisors want to be treated like institutional investors?
Yes and no. If I can say that, yes, they want to be treated with the respect and sophistication, but they want you to understand their business. They really do. And it is different. So if I think about a big wirehouse in the US, you have to treat the firm just getting on the platform. That's step one. Then the harder part is then having an advisor or convincing an advisor to trust you with his or her client's money. So they want to be treated with the respect of an institution, but they want you to understand their book of business, their practice, and their goals and objectives. So on some levels, I think it's different. It's harder. I'm not sure what the right word is, but it's definitely different. You need the sophistication of an institution. You need the backing of an institution, but you really have to understand how wealth operates.
How do you best understand how wealth operates?
Having a team that's either done it, has learned it, and having people out there in the field. I've just picked on my U.S. business, probably have 30 odd people in our sales team that speak to, interact with, liaise with financial advisors all day long. And I'll tie it into a product, not even a product plug, but a product discussion here for a second. I think even though very different, we've talked about these evergreen funds and private funds. I think they coexist very well together. The hardest part, I'll go back to my Oaktree days, had a small but great sales team. You would get on a platform, raise capital, it closes, and you're off. What these evergreen funds have allowed us to do, I'll pick on real estate for a second. I'm on your platform. As long as we do what we said we will do, which we will, I've established a beachhead on XYZ platform. So then my sales team can go in and talk about real estate or REIT. But more importantly, here's Brookfield's approach in real estate. Here's what it means to be an owner, operator, the data we get by operating all these assets and how we turn that into information. So then if I come with an opportunistic drawdown fund down the road, we've been in there. We've understood your needs and goals as an advisor. I think over time, those businesses inform each other. I really do.
It's an interesting question when I think people have talked about this from a portfolio construction perspective of using evergreens as a way to either be a core part of a portfolio or complement a existing closed-end fund. But I think you're hitting on another interesting aspect of this, which is the fact that from a client engagement and distribution perspective, it's actually an evergreen responsibility that I'm borrowing from Partners Group's Rob Collins, who said it's an evergreen responsibility. When you think about it in the sense of the fact that you have an evergreen responsibility to continue to be in front of the people you're working with, talk to them about it. It's not like you've closed, you're out of market, you're back in market in the coming year. It's probably a very different motion of how you interact with clients.
It's very different and it's very atypical. So if you think about how you build a distribution team, my view, people do it all different ways. Having a mix of folks that come from your drawdown, traditional alts, great technical expertise, along with folks from more traditional wholesalers at your traditional shops, very well trained, smart market knowledge, it's a great mix because it is very different. You're on. You have to be on all the time, every day, every hour, every month. And it's almost like you have to create your own catalyst. Why should Michael care about this fund right now? Well, in a closed-end fund, Michael, here's the closing date, in or out. So I've found a nice mix, different backgrounds, both traditional, alternative. I think we have such great investment content. We train our people a lot. For me, it's more about a mix of people. There's no one right way to do it. I found that to be very effective in building a distribution team with people from different backgrounds as far as containers, traditional, alternative.
It almost seems like there's also a really interesting embedded challenge in there too, which is now that firms have evergreen structures, you and your peers are all spending more time in front of the wealth channel. Mm-hmm. You also are sharing a lot of content, but then I bet there's some sort of balance between where, unlike a closed-end fund, right? You have the close date, you then have catalysts to talk to them, which is once a quarter. You put out the quarterly reports, or you have the annual meeting. Very defined times of when you're engaging, and maybe on the off chance if there's an exit or if something happens in the market. But it's more episodic.
The cadence, you have much more control over the cadence.
Yeah. Here, it's a little bit different, right? You now have to both figure out how to get in front of people, but also not inundate them with too much content or be in front of them too much. How do you balance that?
And then at the same time, why should you care, but why should you care now? And also recognize, we spend a lot of time with advisors. It's not just alternative asset managers that are coming after advisors, but all the traditional, all the internal. So I think with that respect, I think less is more from sometimes. So we are publishing a lot because we're doing some of the brand building. Less is more in that publish pointed content when you think you have something to say. I don't know that we've figured it out perfectly yet, but selfishly, I want you, if you see something from Brookfield or Oaktree in your inbox, we want you to want to open that. Howard Marks has done an unbelievable job with his memos. And right, when he has something to say, he writes more memos. When he doesn't, he's not writing. He's not as prolific a writer. And I think that has really helped over time. When you see that come out, you're opening that. We're not at that level yet, but that's how we're going to articulate, here's our investment proposition, but I don't want to inundate. We may do it now. We're trying to find that balance.
I think that's a really important point because it's about the right type of content. I think connecting that to something that you've said in the past is how to actually think about investing. I'd love for you to share that.
Maybe having spent almost a decade at Oaktree, and this is like Howard's philosophy, and he writes about this a lot. It might have even been in his most recent memo. Stark lesson he learned, 69 into the 70s, right? The nifty 50. I think he was in the equity department at Citigroup. The best companies in the world. Within 5 years, you lost all your money. So the lesson that gets ingrained into you in the halls of Oaktree is it's actually not, like you could lose all your money in a good asset. The price you pay is oftentimes the main determinant of your outcome. That's an overgeneralization, but it rings true. Like the price you pay versus the asset you buy.
Unpack that in the context of today's markets where, one, we live in a different market regime than we did, different interest rates.
Yeah, absolutely.
Different valuations, and the blending of public and private, or the intersection of public and private. How should people think about what you just said in the context of today's market?
I guess it'll be slightly different if we go across all of our asset classes, but I think the reason Oaktree and Brookfield as two organizations have coexisted so well together, it's not the same, but a shared investment philosophy, right? We talked a lot about how our deep value investor deliver returns through risk control and consistency. As I get to know and you get to know more about Brookfield, it's a similar value-oriented investment shop. Didn't generate returns through financial engineering or a lot of leverage. It's really delivering returns by buying assets well, then implementing to drive value that way. So as rates have come down, right? People say higher for longer. I think it's more in the more normal for longer. And I think they'll be here for a while. We've seen volatility in interest rates lately, but I think the market is coming our way in that we're driving returns by buying well, but then implementing our business plans. I'm not relying on those outside factors to drive the returns.
How do you impress that upon investors, as they think about private markets, particularly if they're newer to private markets? How do you help them understand?
Yeah, I will say, and I think for our approach, it's probably harder. I think
Why?
So if you, I feel like I'm quoting Howard a lot, but if you ask most alternative or most GPs, most asset managers, what's your number one job? And it's going to be to generate returns. And he's going to step back and say, to control risk, to deliver risk through risk control and consistency. I think it's harder. People expect what I think is the more obvious answer. Here's our return. You're going to know us by doing this. For people to really understand how we derive or how we generate value, it's as simple as we want to give you a bunch of good years, some great years, and no bad years. It's not as easy to just put that in a piece of paper and people say, oh, those are just words on a paper. You really need to get to know us, invest with us, see how we operate through cycles. And I think it really comes through. And even for me, when I joined Oaktree, like it has to sink in. You can see it in the pitch book, but until you really see that demonstrate, are we really going to match our fund size to our perceived opportunity set? That's a hard thing to do. Most firms, you have a fund, the next one's always going to be bigger. By definition, it's going to be a different market cycle. Maybe not by definition, by likelihood. Should you always have more money? And I think Howard has been very disciplined about that concept.
I think that's a really interesting point in the context of maybe investors or advisors who are a bit older can appreciate that because they've been through multiple cycles. But when you think about not just the trend of the wealth channel allocating more to private markets over the next 5 years, but you think about generational wealth transfer, 40 to 60 plus, maybe even, I think there was a stats, $80 trillion over the next 30, 40 years or so. You have to think about building a wealth business at Brookfield Oaktree for multiple generations. Those investors may have grown up differently. They grew up in a different interest rate environment. They have grown up, I call it like investing social. So like they invest leveraging social media platforms for better or for worse. I don't necessarily think it's a better thing. They use retail brokerage platforms. They may buy companies, public equities that are not priced on fundamentals. And how do you then think about how you help educate the next generation of investors on what you just talked about when maybe investors have thought about investing very differently?
I'll go back to what I said, the opposite of. Think about what has manifested after our risk control, consistency, bunch of good years, some great years. The advantage we have, even for the next generation of investors where you might not think we're a natural fit, look at our long-term track record in all of these spaces. I will hold it up against any track record out there. We've delivered returns, we've delivered income, capital appreciation. I think our advantage is we've been doing this for decades. We've delivered, and I think that's going to matter. New generation, old generation, I think maybe not on the closed-end drawdown funds, but these evergreen funds will be on some of these platforms. Clients, the next generation of clients will be able to access them, and I think they'll focus on maybe more so the return aspect there. And if you see how our returns have compounded over time, that's how you win in the long term.
You mentioned decades. How do you impress upon the fact that investors should think in decades?
Yeah, I don't want to just harp on returns, but demonstrating, let me pick on private credit for a minute. It's ballooned. It's probably $1.5 trillion, maybe even bigger in assets right now. Oaktree started its first private credit fund in 2000, 2001. So through different cycles, through different economic backdrops, I think you impress this on people through your results and you talk about your experience and your history and what you've seen. Because by the way, everything doesn't always go as you thought it would go. Everyone says we'll take the keys if it goes wrong. Have you done it? Have you led a restructuring? Have you taken companies out of bankruptcy, through bankruptcy? The answer on all of those points through Oaktree and through, it's yes, we absolutely have. So you impress, again, wrap it up to that broad topic of education and brand, but brand, what does it represent? That's why it's hard. I say hard, it's a lot. You have to articulate that. Because in good times, it's very hard to distinguish one from the other. I'm an XYZ private credit manager. Maybe private equity dispersions, you'll see a much wider dispersion of returns. But in private equity, a lot of them are hugging around the same. You can't distinguish that much. It's when things that go bad, when things go not according to your underwriting, is when I think having that GP with decades of experience really matters.
How do you effectively, both in terms of brand and in terms of, in tactical meetings with advisors, showcase what the history and the DNA of these firms are? Because I think private markets are newer for many people. Brand recognition for many of the firms is still newer for not everybody, but for some. So how do people make sense of the fact that this is Oaktree's DNA? This is who they are, where they came from. They have thought about distressed high yield for a long time. Brookfield, you mentioned, was an owner-operator for 100 years. How do you impress that upon people?
If you look at our, I'll call it a marketing deck pitch book, we trade very heavily into that, and we try and start every discussion with that. Let's step back and tell you where we came from. Kind of will give you a good sense of where we want to take you. I think it's important. So don't start with your returns or your track record or the market. Let's introduce ourselves first by investing with Brookfield Real Estate. Here's what you should expect. Here's what we're good at. Here's the markets that we're in. Here's the team. We run almost $300 billion in real estate. So in all of our marketing material, in our insights, it's really about us, our history, our background, and then we'll talk into how we morphed. Oaktree wasn't a private equity firm. These are credit routes that have morphed over time from high yield to convertible securities to distressed, right? How many people were doing distressed in the mid 80s? Nobody really, I don't think. Bruce Karsh and Howard Marks were. A lot of lessons learned in that time. A lot of teams built off of that expertise.
What have been some of the biggest challenges of integrating the two brands together?
Well, interesting. And we started out, I said they're both separate. They are. So creating what I sit in, this Brookfield Oaktree Wealth Solutions, at first confusing to the marketplace. So I think other GPs may have an advantage of only, here's one, we represent that. It was a little challenging at first. But if I can step back and talk to investors that, all right, wait a minute, we're building solutions, insights, partnerships across two amazing brands. Once we start to get people to understand what we represent, and I get support from great support from both organizations, you turn a challenge into a huge advantage. But trust me, that we're here in the Americas, in Canada, very well known, both brands. Across Europe, certain parts of Asia Pacific, not as well known. Maybe Brookfield or Oaktree is known. So we're spending more time out there in region with senior people and some marketing to get it out there. But I don't know, internally I say, I am the private wealth arm of Brookfield. That's what we are. I'm technically a Brookfield employee with the great fortune to represent two amazing brands.
I want to touch on something. We looked backwards saying, okay, what are the histories and DNAs of these firms? I want to look forwards in the context of the question I asked earlier about the thinking about investing over decades. Yeah. Many of your businesses are touching on investing in mega trends, whether it's digitalization, AI, data centers, whether it's decarbonization, real estate fits in with that. I think when you think about some of the strategies you have, that really is about investing over long periods of time. How much does that cascade down in terms of how you help people think about investing for the long term?
I mean, we think so. You mentioned digitization, deglobalization. I would even add decarbonization. These are multi-decade trends, we think. Enormous capital required around each one of those themes in all the asset classes that you mentioned. That's at the forefront of a lot of our literature. At some point, it's, can we just put our expertise in the path of these amazing long-term trends, and can we articulate to you that we are the right person to trust, right? The trends are there, they're happening. Are we the right investor to partner with? We think we are. And can you position our funds and our strategies to capitalize on that?
Why do you think scale matters so much in some of these categories?
The enormous amount of capital, some of the deals you pick on infrastructure, some of this scale matters because there's only certain people that have the capital to actually execute on some of these deals.
Does that make those deals less competitive, not more?
I can go both ways on that. In certain instances, yes. Do people have the scale, the amount of capital, and the expertise to pull the transaction off? There's very few firms that do. There's several large GPs out there that could. Then you may see more consortiums get together. So someone will always fill a void to try and do that. But I think scale is of paramount importance. But for me, it's global presence, scale, and operating employees. Those three together are what gives us an advantage. It's not just scale, but scale is very important.
So how do wealth channel investors think about that? Because, on one hand, when you see large amounts of capital flowing into a space, call it private credit as one example, infrastructure probably another example, it can, in some cases, generate a more challenging environment for returns because more opportunities or more capital flowing into a certain number of opportunities,
right? Too much
returns
capital
may go
chasing.
down. How do you navigate that with the wealth channel when they say, okay, yes, you have scale, but maybe there's smaller managers or more niche opportunities where you can generate better returns? And how do you then think about that? I think there's right products for different types of investors. So there's no one right way to think about it. But how do you navigate that whole conversation?
There's not, and it's challenging because you know how many GPs are out there, and some people have great small mid-market strategies, small market lending. The big guys can't touch this. I think an advantage of, again, maybe we'll pick on real estate for a second. It hasn't been so much large platform acquisitions. And if you look at ours at owner-operator nature of our business, we can do rifle shot. We can do small acquisitions of individual properties adjacent to where we own. We could do big scale portfolios. In private credit, we can go up and down from mezz through opportunistic lending to mid-market lending to non-sponsor lending. So I think we can compete on many different fronts, not just on scale. I think scale is, especially if we're talking infrastructure and private equity, super important. We can compete where others can't, but we also have the ability to execute on deals that are not extremely large, but maybe smaller. I don't think we're going to do really tiny deals, but we can compete in a variety of deal sizes across the complex.
Are there areas that you think are complementary to what you have today as a platform? Because I think there is an importance of being multi-strategy or multi-product, particularly if you're a larger firm and have the scale to cover so many different geographies, asset classes, et cetera, but that you think would be complementary or additive to what you're doing today?
Yeah. We've started to look across the secondaries. Secondaries is a very interesting area to me. I think that could be done well in infrastructure, in real estate, in corporate credit or private equity, where both Brookfield and Oaktree Credit have been spending time in adjacency is more on asset-backed finance, both out of Oaktree. And I know you may have seen that Brookfield acquired Castle Lake or 51%,
sure.
April or March of this year. That could be the next evolution of private credit if it plays out how certain market practitioners think it will, right? That had always been dominated by insurance companies and banks, insurance companies more on the investment grade side. There may be an enormous opportunity for private capital to come in there. I'm guessing at the number, I think private capital probably represents 5% or so of that right now. I think that could be an enormous number. So, and I'll use adjacent the right term. I don't think we would do something just totally out of left field. Like it has to be somewhere in the Brookfield or Oaktree in that ecosystem.
Mm-hmm. Pine Grove is another example.
Pine Grove, another great example
in the
of
secondary side,
right? And a lot of history there through Sequoia and Oaktree and Sequoia Heritage and now Pine Grove. So there has to be some commonality there.
So you mentioned the wealth channel is still only a few percent allocated to private markets, and still there's so much ground to cover. You mentioned in one of your surveys, the Alts Institute, I think it was something to the order of advisors would be much more likely to allocate to private markets if they knew that their high net worth investor clients wanted them to allocate to.
Yeah.
Talk to me about that.
Yeah, and this survey, so we surveyed advisors and clients in the US, Canada, and across Asia Pacific. The most interesting thing, and it broke out clients and advisors that use alternatives, those that don't. Of those that do, it was really eye-opening. It was like 88 or 90% would do more alternatives. 50% of that cohort would have 20% more allocated to alternatives. The non-users was about 65% of them. If my advisor would approach me with alternatives, I would be open to them. So it hit on a couple of key themes for us. Enormous opportunity for advisors It's almost like if you're not focused on alternatives or private markets, your client acquisition strategy, I think, will suffer. I really do. And for your existing users, there's real room to grow them. It's interesting though, as a globally, we'll guess at a number, it's probably 3 to 5%. If you look at, you see models calling for 10, 15, 20. Hopefully we'll catch up with the evolution of these new containers, ease of execution, less cumbersome. But there's really, we talked about putting our investment trends in front of some of those trends, putting a well thought out, well-staffed, well-resourced wealth business in front of these trends globally. Like, I can't be more excited about what our team is building across Asia Pacific. A lot of wealth there. Private banks really focused on alternatives, very low penetration. I think there's an enormous, I know we've been talking mostly US here, but there's an enormous opportunity globally with same strategy, same trends that we're seeing.
I want to unpack that a little bit. How do you think about the differences between regions in terms of how to, A, build a distribution team to serve investors in each respective region, but B, also the differences between those advisors and end investors in terms of how they want to interact with asset managers and invest in alternatives?
I would say it comes down to the team you hire. And don't try and export a US or Canadian strategy across the globe. I'll go back to lessons I learned in my time at Citigroup. When I first got there, why do you have country heads and all these? You need to understand the advisor base, the client base, and how they operate. If you just try and push your US-centric strategy across the globe, it will fail. Again, someone will always show me an example of someone that got lucky. So we've built our teams locally. So most of our presence right now in Asia is in Singapore, Hong Kong, Japan, and we just started a presence on the ground in Australia. People staffed in those markets, have lived in those markets, understand those markets, have been working in those markets for a long time. And again, alternatives folks, traditional folks, and really letting them craft the strategy, knowing what we're trying to execute on here, but crafting the strategy and bringing back to us, okay, in Australia, I'll pick on, if we're going to really grow our presence there, we need to be open to doing Australian unit trusts. We're going to partner with someone that delivers this private credit product, how Australian investors want to invest. So again, you hire the right people locally. We've been very fortunate to have great people on the team. We're still growing that business. We've hired some really good people everywhere, but specifically across our Asia Pacific business. Got a great team out there. They've done an amazing job. And I think if I look at my business today, it's probably 50 or 60% in the US, but I think the growth is really coming out of Asia Pacific region.
Do you think brand matters more or less in other parts of the world?
My gut is to say more, but I might be saying that because I don't think they know us as well, us being both Brookfield and Oaktree and some of the places I've traveled to across the globe. So I'm gonna go with more.
Is the way in which you deliver education and brand different in other parts of the world than it would be in the US and Canada?
There's more commonality to that than I would have thought or you might think. We have great relationships with global banks and large regional banks. And again, going back to what I said earlier, partnering with them on their sponsored events, I've always found is a very effective way to do that. Maybe more media, more public stuff, more LinkedIn, things like that around Asia they look for, but very effective to partner with organizations that you're looking to do business with in their sponsored events. And again, like I said, in the US, we'll do our own events at some point where we bring people in. We'll probably do that in other jurisdictions as well.
From building out the distribution team and educating your own team, is the type of professional you'd hire on the distribution or sales side different internationally than you'd hire in the US, or is it the same where it's you'd hire people who understand both private markets as well as people who've been mutual fund or ETF wholesalers?
It's been more the latter of a mix. And as I'm looking at folks, I think the most important thing for me is we're trying to build a culture of what I call shared success and folks that understand grow the pie. So I want people that want to be here for the next 5, 10 years, that understand our brands, what they represent, and that we want to win in the long term. So it's not always just one salesperson that's got the biggest book of business. I want really people to understand it's everything that's enabling your success. It's the product team, it's the investment team, it's that IR team, the support team, the compliance team. Not everyone thinks that way, but that's the culture we're trying to build.
What do you think is the harder aspect to teach? Is it the educating salespeople, distribution, marketing professionals on private markets and their strategies? Is it educating that constituent on the wealth manager, how they work, who they are, building those relationships and those relationships of trust?
Having sat in this space for a long time, it's more the latter. How you approach, in my view, how you approach the advisor, how you deal with the advisor, how you articulate your story to the advisor. We have so much content. We can train our people, and I think we do an excellent job of training our people to think less about products, understand Brookfield real estate, understand our value proposition. These are smart people we're hiring. They're going to learn how we do that. The softer side, the advisor interaction, that's hard. That's challenging. That takes time for people to get. I think it's harder. I'm sure you'll get many different answers on that topic, but that's what I've seen.
I think you said something earlier which really resonated, which is that working with the wealth channel is its own unique thing. You have to figure out how to work with them. Yes, they want to be taught. They want to be talked to and taught in an institutional quality way and respected in the same way that an institutional investor would, but there's differences in working with them.
Very different. And the money doesn't come. Trust, education, presence, people, you have to be there.
You mentioned that we're in early innings of this in the wealth channel.
As amazing
you've
that it
been
is.
in this industry for 25 years. How early
So
are
I failed?
we?
Is that
No, not at all. No, we're right at that inflection point, but just how early are we?
Listen, I said early innings. Maybe it's middle innings, 3 to 3. If we're playing, or I'll quote Howard again, you don't know how many innings are in the game. 3 to 5 in a 9-inning game, maybe it's 3. I really think, you're heavily involved in technology. The ease of execution, I think, has done so much for the evolution of alternatives. I'll talk about it. If you and I were chatting 2 years ago, I would have said evergreen or perpetual funds would be 45-50% of our business by now. It's over 70%. It might hit 76% for 2024. So the rapid evolution has surprised me a bit. I think that's a big part of what's going to drive the future growth of alternatives. Performance has been good in these structures. People have delivered. You're getting the support you want. You have a little bit of liquidity. We're buying generally illiquid assets, and we're offering managed liquidity. I do not talk about these structures as liquid, but we have some liquidity. That ease of execution in the U.S. market at 1099, seeing it on your statements, smaller investment size, accredited investor, that's just helped turbocharge this in a way we would never have done just selling private funds. But it's not as new. You mentioned Rob Collins before. They've had an amazing private equity product for a long time. I think I probably met Rob when I was at Morgan Stanley. So there have been some pioneers in the space. There have been registered hedge funds. There have been single manager hedge funds. It's just now hitting a lot more asset classes, and people are thinking more about, all right, now I have private credit, I have some hedge funds, I have real estate, I can now build a portfolio. I think that's also taking it to the next level.
So you led right into where I wanted to go next, which was the concept of model portfolios and building and constructing portfolios, or you said it before, solutions. How do you think that will change how the wealth channel works with alternatives managers and invest in private markets?
Multi-asset portfolio solutions. So if it were single managers and then it were private equity real estate and then these evergreen funds, you just hit on what I think is going to be maybe the next real leg of growth in models, in portfolio combinations. You'll see some more hiring out of Brookfield. You'll see some big names come in, maybe from some of these shops. I think that's going to come down to, though, having the right team and the right people. We're making a big investment in people to focus on that.
How do you think the model world shakes out?
I think you'll see GPs trying to do it. I think you'll see OCIOs doing it. I think you'll see big platforms doing it. If you think of how models revolutionize some of the traditional asset management within the big wealth platforms, we're still a little cumbersome in our execution of alternatives, but if we get there, I think it'll be every flavor.
I'm very curious to see how that unfolds, because you also said something else earlier, which is you think that private markets are still, for the most part, sold, not bought. What changes that?
Yeah, I wish I knew because I would pursue it immediately. I don't know. I find that you need to give folks a reason to care about you, your strategy, and why now. I don't, models can certainly change that, right? Bigger picture, stepping back, OCIO, maybe investment officers driving that behavior, that will help. But on the individual asset class, that's going to be a long time.
Do you think the whole market structure evolution in wealth management, what I mean by that is the advent of private equity coming in, consolidating firms, roll-ups.
Yeah, we've seen a lot of that.
Acquiring OCIO, Cerity Agility, Hightower, and EPC. Does that change how advisors will end up allocating to private markets?
I think it could. I think you're going to have more of that chief investment officer approach type where you'll see folks at these bigger RIA shops that have been rolled up doing more of that command and control, whether it's a true model or just recommended portfolios. I think that's probably still early stages, but yeah, we're seeing a lot of that. I think that will go away from just an individual conversation on one fund to more the portfolio context.
Do you think that makes it easier or harder to work with the wealth channel?
Maybe harder, because you're still going to have to do both. Harder, more rigor to diligence, but ultimately, I think it's a good thing. I think this growth is good. It's good for us. It's good for Brookfield. It's good for Oaktree. It's good for our competitors. Go more mainstream with alternatives. I think that's a.
You captured it all very, very well. I always ask to wrap up everyone what their most interesting or favorite alternative investment is. I've usually asked, okay, looking backward, what has your favorite or most interesting investment been in the space? But I think the world's changed so much. I think it's more interesting to get a forward-looking view on that. So from your perspective, what do you think is most interesting in private markets in terms of investment strategy, perspective, et cetera?
Again, I'll talk my own book here. What I think, and my personal view, actually really excited about real estate. And I may be alone in that view. I think the opportunity globally in real estate is amazing. You're buying high quality assets with good fundamentals at depressed prices, great entry point. The issue we're seeing is I can have that conversation with research folks, home office. Advisors and clients might not be there yet globally, right? Real estate's been challenged the past few years. I think there's an enormous opportunity in real estate. I like private equity. Maybe I'll talk all of our books. I like what we're thinking about in ABF. If we're right, and there really is a dearth of capital from banks stepping away and from insurance companies only focusing on that core piece, the investment grade piece, there's going to be an enormous need for capital from firms like Castlelake, from firms like Oaktree, that I think are going to deliver really good returns to people, but maybe it'll tie it back to what we've been talking about with risk under control. Like if I can deliver to you that nice 8, 10, 12% return with very low risk, and by that I mean, as you know, we've talked, I view risk as probability of loss, not a volatility metric. I think that's a great return. That's really exciting. If I could put those types of revenue streams in my portfolio, that's what I'm looking for. And I'll give you my coolest one if you want, but
would love to hear it.
Music royalties. If you look at some of the acquisitions that Brookfield has made in that space, it's just fun. You can see the artists that we invest in, how you can approach that business where both parties win, meaning growing the revenue streams alongside an artist or the artist's estate. You can win-win and not be on the wrong side of some of those strategies like we've heard about.
I want to touch on a different aspect of that, because I think this applies to real estate, it applies to infrastructure, it applies to music royalties, which is not to diminish the importance of generating investment returns regardless of the underlying asset. But something like music royalties, it's something that people can relate to, right? People love music. They might know some of the artists.
They know the artists. They love the catalog.
How do you tie both of those things together? The human aspect of understanding what people are investing in. How important is that, particularly with the wealth channel? Because I do think there's an element of certainly firms themselves, alternative asset managers, they go public, are becoming more consumer brands to some extent. And I think the investments they make kind of do tie into that and help people understand what they're investing in.
It helps tell the story. I still find folks are zeroed in on the returns, whether it's in things like music royalties, or even transition investing, people want to understand, okay, what's the economic return at the end of the day? The story helps, it resonates, people like it. I think they like the cocktail party discussion on the music royalties. But if they're going to commit, especially if I'm like longer term 10-year partnerships, the economic return needs to match or needs to be high enough for clients and advisors to lock up their capital for 8, 10, 12 years.
I think that's a great way to end, because at the end of the day, that's what's so important. Private markets are going to have to deliver for investors. At the end of the day, it's down to trust, partnership. And I think that they're different investments and they can be cool and interesting, but they have to deliver.
You have to deliver.
So
Absolutely.
it's a fantastic way to end this conversation.
I love it.
Thanks
Michael,
so much, John.
Great to be here. Thank you.
Pleasure to have you on the show.
Thank you.
Thanks for listening to this episode of Alt Goes Mainstream. I hope you enjoyed it. You can read more about alts at my Substack, altgoesmainstream.substack.com. Thanks a lot and have a great day.
We're going